What's up, guys? Welcome back to another episode of Stock Talk with David. This is the weekly live stream for the week ending Sunday, March 6th. So let's get into it. Let's look at some updates from the weekend. The very first thing that we can check out is that commodity prices, futures market, absolutely just soaring. We've got crude oil 8% up, Brent 8.8, natural gas 0.82. So just all the commodities are moving up really, really quick. Obviously, this is from the Ukraine crisis in Russia and all that. So pretty intense what's happening over there. And then we can look at some quick updates from the weekend. We've got gas popping up. We have a lot of news around the oil industry, which is interesting. Carl Icahn, legendary guy, he's selling off his Occidental petroleum stakes, so ticker symbol Oxy, after almost 3 years. So that's pretty big news from him. And then we'll go down a little bit more. We'll just see that authorities are taking over a lot of Russian assets. So all this stuff is happening right now. And a lot of it's commodity based, and it's just going to trickle slowly into the stock market. Like, we can look here at the fear and greed indicator. This is updated on March 4th, so this is on Friday. Extreme fear. So historically speaking, buying at extreme fear times actually leads to really, really good returns, right? So that makes sense. You buy when people are fearful and you sell it when they're greedy. So that's kind of the idea that we're tracking into this. But I wanted to look a little more into the commodities again, because we do have some ideas about how to make this work. So a couple of things that I'm looking at here are going to be, let's see, they should have the coffee on here. So remember last week's stream, we are actually short on Starbucks for the very reason of supply chain issues. Here we go. So yeah, you guys can actually see that coffee is pulling back a bit to $2.24 a pound. So it's actually holding that support really nice. It could get a solid bounce or it could break through, but everything, if we have to think about what's happening right now, it would be very much that the coffee would bounce off of that level. Cool. So then if we go back to the, let's see, then one thing I want to pull up here is going to be SPY. We'll check out SPY. We can see that it's just been getting absolutely slaughtered since the beginning of the year. Hasn't gone quite as far down as it went in the beginning of February, but it is getting a lot of that upward pressure or downward pressure. We can notice that right here, right? So a level to watch out would be that 400 level. I know that's extremely pessimistic, and it would throw off the markets quite a bit, nearly 7%, I guess. But that's pretty intense, guys. That's where this thing could bounce. But then again, it could get one couple good closes up here, and we're back at the top again. But this is all going to be determined on Ukraine policy, and it's not even going to be so much what Russia does. It's going to be how the world reacts to it, right? So how are we going to negotiate with them to get them to cool off, to come to the table? And I'll go into the table a few times about how to actually get further and how to maintain progress and achieve that, right? That's what we have to look for. I'm no expert in that. I can just only look at the markets. I can tell you that right now, the time to be in certain stocks is, like, we don't want to be in these long duration assets. Like, if we look at let's look at NASDAQ. All right, we don't want to be, because a lot of these tech stocks here, they're great companies, but here's the thing is they're not extremely profitable. And if they're not extremely profitable, they're going to get absolutely slaughtered. They don't have any cash flows to fall back on, right? With interest rates and all that stuff been going off on. So I think that makes sense. We can see that this is still getting brought down a bit. The next thing I wanted to talk about is actually going to be, we'll look at some of the indexes. So we'll look at XRT, just get an idea of where we're at. Retail is absolutely just, the retail sector is absolutely puking. The retail traders are absolutely puking too. So I don't want to necessarily be in too many things retail right now, not until this is figured out. I mean, is there money to be made if you take take it on the long, yeah, but for me, it doesn't make that much sense, right? Like, I don't want to be in it. If I have to hold it through all of this right here, I'd rather wait, just get, if you're going to trade this ETF, I would trade it around 80, right? That'd be a good point. Get this nice close, start to build back up. Long term, yeah, I think it's going to be fine, but just the short term pain. If you guys are following us, biotech's actually been a really big one. Been talking a lot about it. See, Eric says, could China be a potential play with Ukraine-Russia conflict macro outlook? Yeah, totally. You actually just kind of went ahead of me there. But we're looking at biotech. I like biotech, and the chart is absolutely horrendous, which is probably why I do end up liking it. But for the very reason that, not to show you guys in a moment, but after the first rate hike, what does great? It's actually technology. So rates go up, and technology, the multiples in tech, they actually move up. Now, why is that? Well, it's actually a lot of people, they will leave the safe stocks. They'll be looking for growth. They'll be looking, and they'll pile back onto it a little bit further into the cycle, about 3 months after that first hike. So that's something that to keep in mind. Now, what does it do with biotech? Well, biotech's kind of the same thing. And biotech, it has the same characteristics as technology, but it has one really fundamental one. It is that the patents are starting to come off this year for a lot of these smaller cap guys. And what that means is that the bigger pharma players, they're not going to want to spend money on R&D and upset the shareholders. They'd rather initiate M&A activity, pick up the patents, just merge them, throw one in, get the accretive EPS, and you're going to see a lot of bouncing to the upside here by the end of the year. So I think the risk is to the upside. I mean, we're just looking at some of these sectors, some of these industries, and they're just not looking great. This is the time to be buying, right? Retail, I'd be a little iffy about given some of the inflation stuff, but I would say generally biotech is a solid one. And so Eric's asking about China. Let's see, I forget the name for the Chinese ETF. I guess we can use this one. So yeah, Eric's saying potential play for Ukraine-Russia conflict. I've heard some reports that China's not necessarily supporting what Russia is doing. It doesn't really align with their interests, because if we think about it, the relationship is so symbiotic between Russia and between China and the US. It's extremely symbiotic. So what that means is that if China makes any alliance or any concessions towards Russia, it could really hamper the relationships with the US. And China is not on a point in their economy that they need to be making risk like that. Okay, so if we look at this, is their ETF, shows just their stock market, kind of like their S&P 500, I guess. We can just see them absolutely slaughtered. This has to do with a lot of the crackdown from President Xi. And we're noticing that as they go into their People's Congress, when they start to elect new delegates, they start to elect the president eventually, the cabinet, things like that. You'll see that they get very at ease with the policy, and this will start to reverse. This is actually one of our macro drivers for Alibaba, which I think is actually a fantastic stock. Talked about it last week. It makes perfect sense why. The thing's growing faster than Amazon. They have better numbers. They have a broader range, broader reach than Amazon. So it's extremely, I hate saying cheap, but it's extremely cheap. And we can see that right here. I mean, this thing, the EPS has doubled, if not tripled, from the time that this stock price was out in 2017, and it's down at the same levels. So you're buying 3 times the growth at a huge discount, right? It's a good question, Eric. Let's see. What else do we have? We can get an update on our Starbucks play. So I think when we called out Starbucks, we were right around $90 somewhere there. We got to close at 90.03. Could it go lower? Yeah, that's the thesis. I hope it does. Our particular play that we have, we're doing a calendar. We don't want it to go down past 89 too quickly. We want to get a little bit of that credit we can get in there, pick up that credit, lower our cost basis, and then we can just drive it down to the upside. Remember, the price target worked out was actually between 70 to 65, which is extremely bearish, but given what's happening in the retail and consumer discretionary, given where our consumer sentiment is, I think it actually makes sense. Just the entire picture makes sense, right, for this. There's a lot of negative momentum in a quick amount of time. So that's the thesis there. What else could we look at? Eric, do you have any stock ideas for us? You're still in the chat. See, so I'm going to look at, see if he replies, but we'll look at Apple really quick. This is a good indicator for tech as well, because Apple's such a large company. Everyone knows Apple, they get it. It's not that hard to predict. So we're just seeing here, yeah, it's coming off. This is, we had a peak at 180, we're at 163. Okay, fair. What I do think with Apple is that they're going to be a long growth story. They're adding all the subscription stuff to it. So that'll be great. But I just want to get an idea of where the pulse is on tech. So kind of makes sense. That's actually interesting. Check out the 10-year. Eric says not any good ones. Okay. I don't think anyone has fantastic stock picks right now. They have some deep value plays for sure, but some of the short-term stuff is a little bit tricky. Okay, so 1.7 on the 10 years. So this is actually going to kind of a proxy for where the Fed funds rate. It's a proxy of the proxy, but it's the easiest to use, and so that's just getting absolutely demolished. So I would stay completely out of banks right now. I would stay out of anything in the financials. Again, opinion, not advice. I don't know your financial conditions. So again, this is just for educational reasons. But if we go to XLF, this is the financial fund. Okay, so you guys can absolutely just see here, we got a good run up here, post-pandemic, right? After the March declines, running up, and then it just stalls. And this has a lot to do with the interest rate talks, 41 all the way down to 37. It doesn't seem like much when you think about the stocks that make up the underlying. That's pretty intense, right? That's a lot. I know Spencer last week, he was talking about Disney, so let's give Disney a quick little look on the financials. I think this is one that could be pretty significant and actually a strong play. So I didn't look it up for him the last time, I don't remember. So look at the key stats. These are the important things, guys. We want to look at gross profit if you're new, just looking at some of the gross profit for Disney. Want to get an idea of where they are year over year, what are the estimates. So definitely, if we look at 2019, they're not quite there. Go this way with it. Okay. You guys should be able to see this now. So they're not quite there. They're doing a lot better than in 21 and doing a lot better than 30 in 2020. So we're comparing to 2019. They're not quite there. They're still about 5 percentage points off or away. And they're going to be estimated in 2022 to hit the 35% gross margin look, so that would be a good setup for them. I like that idea. Gross margin is really important because it determines on how much the company can, start to close in on that net margin, right? The net income. Look at EBITDA. EBITDA is starting to recover. That's a pretty sharp recovery in EBITDA in the past couple of years. That revenue number, this is what I find the most interesting, is that they're actually making more money in 2019 than they did in, they're making more money now than they did in 2019 and way more than they did in 2018. So this could have to do with the Disney Plus streaming. It could do on the opening of the parks, a lot of things there, right? So I find that extremely cool. Look at the cash flows. This is going to be the one thing that I want to know more about, is where did they get the money? Did it come from operations, or did it come from other people's money? And Eric asked, any new updates on rate hikes from Jay Powell? I don't think so. I think the latest that we heard was in testimony last week, saying that he's keeping a close eye on the Ukraine situation, and he may or may not be looking to be as aggressive as he was. So I don't think that really helps much Eric, but that's basically what happened. But just because he gave that really broad comment, and we just looked at the 10-year, this is when he started talking, and this is when he ended talking, essentially. So that's pretty significant right there, isn't it? Was that like 10 basis points right there? Like that's a lot. Okay, so we'll go back to the Disney, and yeah, so we're not really taking on any debt, so that's a good thing. Paying back just a little bit, so that's good as well. So I like that. So yeah, their money has come from their operations, which is pretty strong in my opinion. Let's see, anything else? We did trade Burlington Coat Factory, so if you guys were in that play, we took it all the way from 150. We took it from 250 to about 190, which was fantastic. So we got in right around this area, this 240, this 250 area, somewhere in here, and just drove it all the way down. This has to go with our retail play that we were talking about, with retail absolutely puking in the retail sector. Can't keep up with the supply chain. They reported a lot of problems with their foot traffic, with their stores. They have a huge debt to equity ratio, so they're absolutely pinned. They don't have much going for them in terms of financial strength, maneuverability, anything like that, right? So that's why it was a great short. It was a great play. I still have some on, and might even be looking to add soon. But that's a different setup, different headache for another day. We already talked about coffee. Let's see, what else is there we can talk about? Look for any more news that might have missed. So yeah, this crude oil jumping to 125 a barrel, like you have to think about it, guys. If you're looking to get onto that play, like if you're saying, I want to get on crude oil right now, like I want to start trading oil, I'm going to get into Exxon, I'm going to get into BP and Shell, like you're doing yourself a disservice. Everyone is crowded into this trade. So why would you trade it? Everyone has the same idea as you. You're not the first one with that idea, so what good does it do for you to trade that, right? It does absolutely nothing for you to do that. Here we go. So we're going to look at the crude oil futures. Okay, so we'll have to go this way with it. Commodities, crude oil. So yeah, like if you guys are trying to trade this, why look at how high this has gone. Just simple logic would tell you, yeah, I'm not going to trade this. I'm going to look for the next new thing. And what could the next new thing be? Well, we're looking at slowdowns from manufacturing, right? We look at the services PMI. The services PMI is starting to move up, right? We're starting to see it grew for the first, it grew again for the 21st month in a row. That's great. Manufacturing's come back online. But the manufacturing, supply chain, all that stuff, I think we're going to go back into the services again, right? So services was down 3.4 for the month. That's okay though, because why? Well, new orders are still growing. The employment from there is actually starting to contract some, so that's not the biggest thing. But the inventories are growing that they're getting from these things. So what are they saying in services? Inflation is contributing to budget constraints as in education. Employee turnover within our company and with our suppliers is causing delays in decision and orders. So when we're printing money like this and we're having issues getting staffed, it's going to lead to increases in prices. And one of the places that's been most overlooked has actually been services, because we've all gone to the manufacturing. We've gone to the GMs, we've gone to the Fords, right? I think some of you guys have done that. And that's great. You've got the manufacturing down, but the service has just been left and taken out to the woodshed, and now they're dead. So I think our job to look for is definitely to start finding some of these some of these services companies that were just left, and we sort of pick them back up, right? Utilities appear to be on the upswing from COVID from an absenteeism standpoint, still dealing with long lead times for wire, PVC, steel, transformers. This has a lot to do with literally your electric or your utilities. So that might be a play, right? If we understand that usually rates peak after the hype of the rate peaks after the beginning of the announcement, well, maybe being into a instrument like a utility play, an XLU, might actually make sense, right? Just some ideas. I mean, are they all going to work? Absolutely not. Do they need to be researched? Absolutely. But these are just the places where you would get these ideas. Like, look at XLU, right? I haven't even looked at this chart, and that's looking like it might actually be a hell of a play. It breaks this level. We've got this right here. It's safe money. We're getting a dividend. Not the most volatile thing in the world. I mean, is it an absolutely gorgeous chart? No, it's slow. It's grinding. But, you know, you add a little bit here. You get past this 72 level. You add on the pullback of the breakout. I think that makes sense. You know, from 18 right here, look, rate hikes. So I think it could actually have some room to go. I don't know what Eric thinks. Let me know what you guys think in the comments. So that's something I'm going to add to the list is XLU actually, because this could be a pretty strong idea, or at least getting into things like that. NNN, Triple N, this is a really good property REIT. They have, what companies do they have? They have LA Fitness, 7-Eleven, AMC Theaters inside this property REIT. Real estate tends to do well after a rate hike cycle. So yeah, this could be something I think that might have some bearing as well, some plays on it. So this actually might work. So NNN, yeah, for sure. And I'll be sure I'll post this later on in one of the posts, guys, on the YouTube for you guys to see what does well before and after certain months during a rate hike cycle. And when you can see that, you can really understand what to look for, what to trade, what to invest. So I think that'll help you guys a ton. Eric says, yeah, utilities, less volatile, consistent dividend. Completely agree. I think real estate, in the fact that it's a store of wealth, it's kind of hard to trade it on the open market because you have to deal every single day. Then you're getting kind of like the approximate value of the real things, but maybe getting into a REIT, the dividend, you know, especially this rate hike is not as severe. If it's 25 basis points versus 50, I think anything with a yield is going to do just fine. Might be a little contrarian. I might be early on that view. I have a problem actually being pretty early to some trades, but I end up normally right, and I would say this could be one of those situations where I'm right, but I'm really early. It might be some pain, but you know, you come here, you're at 42, and then before you know it, you're at 60. You know, like, was it worth the pain? Yeah, it's better than being the guy that gets in right here, has a great idea, pukes it out, bam, right? So start small, add, right? Different ways to do different plays for sure, but that's how we do it. So guys, I think that's about it. Thanks for tuning in. If you enjoyed today's live stream, be sure to subscribe to the channel. Check out the Discord and the link. We've got a ton of smart guys in there, always posting some good ideas. And so that's all I have for now, guys. Have a great week.